Here is a question worth sitting with on Friday the 31st of July, 2026. If the last crypto bull run was powered by a spot exchange-traded fund launch and a halving, what exactly powers the next one? That question is circulating today because CoinDesk has published comments from the chief executive of STS Digital, a digital asset trading firm, arguing that crypto now faces three major headwinds before any fresh sustained rally can take hold. That framing matters because of where it comes from. This is the derivative side of the market, not a retail commentator with a price target. Desks that make markets and options see positioning, funding costs and hedging demand before those things show up in the price chart. So when that corner of the industry starts talking about barriers rather than targets, it is worth slowing down and listening. Over the next few minutes we will unpack what those headwinds look like in practice, what has genuinely changed since the last cycle, and what all of it means if you hold crypto in a British account right now. To understand today's warning, you have to understand what the market already used up. Two dates did most of the heavy lifting in the previous cycle. On the 11th of January, 2024, United States regulators approved spot Bitcoin exchange-traded funds, opening the asset to pension platforms, advisors, and ordinary brokerage accounts for the first time. Then on the 20th of April, 2024, Bitcoin's fourth halving cut the block subsidy from 6.25 to 3.125 coins, tightening new issuance overnight. Those were one-off structural events. The ETF wrapper cannot be invented twice, and the next halving is not scheduled until 2028. Spot Ether funds followed in the summer of 2024, broadening access again. The point is not that these were bad developments. They were transformative. The point is that a market cannot keep repricing the same news. Any argument for a new bull run has to identify a genuinely new source of demand, and that is precisely where the skepticism from professional trading desks is now concentrated. The first headwind is the one crypto has never escaped, despite years of claims to the contrary. Bitcoin trades as a high beta risk asset. When central bank policy is restrictive and cash pays a real return, the opportunity cost of holding a non-yielding, highly volatile asset rises sharply. Every serious institutional allocation model runs that comparison. Global liquidity conditions, the direction of the dollar and the level of front-end rates set the tone for everything from technology equities to digital assets, and crypto sits at the far end of that risk spectrum. That is why a rally in crypto rarely happens in isolation from broader risk appetite. For viewers, the practical takeaway is simple. Watch the macro calendar as closely as the crypto calendar. Central bank decisions, inflation prints, and bond yields have historically driven more of Bitcoin's direction than any on-chain metric or protocol upgrade, and no amount of adoption narrative has yet broken that relationship for a sustained period. The second barrier is regulatory and structural, and it cuts both ways. The rules have improved dramatically. The European Union's markets in crypto assets regime came fully into application on the 30th of December, 2024, giving licensed issuers and service providers a single passportable framework across the bloc. In the United States, a federal stablecoin law signed in July 2025 finally set reserve and disclosure standards for payment stablecoins. Here in the United Kingdom, the Financial Conduct Authority lifted its ban on retail access to crypto exchange-traded notes from the 8th of October, 2025, and the crypto-asset financial promotions regime has been in force since October 2023. The catch is that clarity is not the same as enthusiasm. Compliance costs are real, listing standards are stricter, and firms that operated loosely in previous cycles no longer can. Regulation has made the market safer and slower at the same time, and slower is not what a speculative rally feeds on. The third headwind is the hardest to solve, and it is about demand rather than supply. Markets rise when someone is willing to pay more than the last buyer. In the 2020 and 2021 cycle, that buyer was a wave of first-time retail investors with stimulus-era savings. In 2024, it was the exchange-traded fund channel absorbing coins on behalf of advisors and institutions. The open question now is who the next marginal buyer is. Corporate treasury adoption has been concentrated in a small number of companies rather than spreading broadly. Sovereign and pension allocations remain cautious and slow-moving by design. Meanwhile, leverage in perpetual futures markets tends to amplify moves in both directions, which means shallow rallies can reverse violently when funding costs turn. A market without a deep new buyer base does not necessarily crash. It grinds sideways, which is often more frustrating for holders than a sharp fall. So how does this land for someone watching from Britain today? First, access has genuinely widened. UK retail investors can now buy crypto exchange-traded notes on recognized investment exchanges, and those instruments carry proper prospectuses and disclosure. That is a meaningful improvement on buying tokens through an unregulated venue. Second, and this is the part that gets missed, wider access does not mean lower risk. Crypto ETNs are not covered by the Financial Services Compensation Scheme for investment losses, and the FCA has been explicit that consumers should be prepared to lose all their money. Third, position sizing matters more than timing in an environment where professionals are openly describing headwinds. A common approach among cautious allocators is to treat digital assets as a small satellite holding rather than a core position, precisely because the path is unpredictable. None of that is advice, but it is how the risk is being framed on regulated desks today. Looking at the weeks ahead, the honest position is that nobody credible is predicting a precise price. What professionals do instead is watch for the removal of those three barriers, in order. On macro, the signal is a genuine easing of financial conditions and a softer dollar, because that historically precedes risk asset strength rather than following it. On regulation, watch for large traditional institutions expanding custody and settlement services, because that is the quiet infrastructure work that precedes real allocation. On demand, the tell is sustained net inflows into regulated products across multiple consecutive weeks, not a single dramatic day. If all three shift together, the argument for a new cycle strengthens considerably. If only one moves, expect the choppy, range-bound behavior that has frustrated traders throughout much of this year. Treat any rally that arrives without those foundations with appropriate skepticism, because leverage-driven moves tend to unwind as quickly as they build. Here is the single idea to carry away from Friday the 31st of July, 2026. The bullish case for crypto no longer rests on a scheduled event that everyone can circle on a calendar. The halving is done until 2028 and the exchange-traded fund door is already open. What remains is the unglamorous work of macro conditions improving, regulated infrastructure deepening, and a genuinely new buyer base arriving. That is exactly why a trading firm chief executive is talking about three barriers rather than three catalysts. It is not a bearish statement so much as a realistic one. Cycles built on structure last longer than cycles built on hype, but they also take longer to start. If you found this useful, do subscribe, because we break down the market news that actually moves your money, in plain British English, every single day. And remember, understanding why a market is not moving is just as valuable as knowing when it will.